You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back once again for our monthly journey, our monthly foray into the world of advisors and options. Yes, it is time once again for the Advisor's Option. My name, of course, Mark Longo from don't forget the optionsinsider.com is the place to go to get all sorts of articles, analysis, earnings reports from some guy you may like to hear on this show, as well as a whole bunch of other stuff. Links, of course, to every show we've ever produced in the 16-plus year history of this network. So be prepared when you head over to that URL. A lot of great content waiting for you there, including a link to a little cool thing called theoptionsinsider.com/pro. Once you go there, you know the old saying, once you go pro, you never go back, listeners. 200-plus hours of shows waiting for you the second you hit that join button. So you could binge for literally almost 10 days straight without even coming up for air, taking a break. That's how much content we got waiting for you. More coming all the time. New pro Q&As, new options oddities pretty much every week. Live access to this, everything else we do. And, of course, great giveaways. Just gave away the Pro Trading Crate for the month of May, putting together the June Trading Crate. So a lot of fun to be had there. TheOptionsInsider.com/pro is the place to go to learn more as we learn who is joining us today on the old AO program. And I am pleased to welcome back once again my co-host and compatriot in all things Advisors Option Crime, none other than Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services. Mr. Matt, welcome back to the Advisor's Option, sir.
Thanks, Mark. I'm excited. My favorite part is getting to questions from listeners, so it's great to have the feedback of the people that follow the show. So looking forward to it, Mark.
Well, you're going to have a fun time today. We got a lot of questions in store for us. But before we get there, let's kick things off with a little segment we call around these parts, the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody, welcome to the P&L statement, the segment that was born of the pandemic. We thought we need to spend some time every episode just coming to grips with what the hell happened since the last show. Hence, this segment was born, and you know what? It lives up to its billing pretty much every episode. Something wonky, weird, unprecedented happens out there in the world of options. And right now, Mr. Matt, one of those wonky things is just the fact that vol is going to die. You know, since the onset of the pandemic, we've really been hanging out well north of 20. Indeed, flirting with the 30 handle and above it quite a few times during that pandemic era. Vol was pretty robust as well north of triple digits for the lion's share of that pandemic, that aggressive pandemic era. Of course, a lot of that has now come off in the course of the past year, and we have seen VIX come off accordingly this year as well, as equity markets seem to be locked inexorably to the upside, except for the last couple of sessions. We are selling off a wee bit today, but you can't complain, all you bulls out there. You're still well north of the 4,300 level in the S&P as we're recording this. Of course, not too long ago, just a few weeks ago, we were shy of 4,100. So nice little pop out there for all the bulls. But of course, all that green maybe having fed somewhat in the rear-view mirror. It's arguable because they have, of course, said they may come back to do more cuts. But for now, at least the market's pricing it like it's in the rear-view mirror. So we are seeing a lot of that vol coming off the table, listeners. VIX hanging out 13, shy of a 13.5 right now, 1340 as we're commencing operations here. So just extremely anemic from a vol perspective. Now, you go back longer term, that isn't that cheap. We obviously have seen VIX lower. Let's not even mention the dreaded year that was 2017. I'm not sure if you were on the network a lot with us back in 2017, Matt, but that was, of course, the onset of the Trump administration. And the one thing every single person on this network predicted going into 2017 is that say whatever you will about Trump, love him, hate him. The one thing everyone can say with certainty is that Trump is not a single-digit VIX president. And what happened? Of course, Trump took office and VIX just went to die. We hit a 12. And that's why I'm eagerly watching for a 12 handle out here in VIX land. Once we hit a 12, I'm going to start getting some PTSD flashbacks of 2017. But of course, we hit a 12 handle, and then it was kind of just off to the races to the downside from their listeners. We got down to somewhere in the single digits, I think a 9 handle in VIX, which is never good for options, for trading, for any of the fun, the volume we always talk about here on the show. So not quite there yet, listeners, but we are starting to flirt with some intriguing levels. So intriguing, Matt, I'll just regale this story quickly. Listeners on Vol Views and other shows have heard it before. Advisor's Option, a little bit different audience. Matt, way back, it was back in October of last year, on the Volatility Views program, we were joking about someone coming in. VIX was around 30 at the time, and buying the June, so these were 8-month out puts almost at that point, the June 15 handle puts. We thought they were hilarious. We also thought they paid up for them because they paid about almost a dime for them, and we thought we can get these for much better. So we ended up doing that on the show. We went out and pennied them a bunch of times and ended up buying a bunch of these June 15 puts. It was just a fun trade to do for content for the show. I had completely forgotten about these until a couple of weeks ago when I saw an explosion of green in one of the accounts that we had put some of these puts in. I said, what is this? Oh, wait. These June 15 puts that I had paid nothing for and were worth nothing until a couple weeks ago, suddenly flaring to life. I ended up selling half of them for 50 cents. After I bought them for, I think, around 7 cents. I ended up working the rest for $1. Didn't quite get there. Of course, maybe if I had been patient, maybe I would have played with it. I ended up getting the rest off for 85 cents. So it was a ridiculous trade by any measure. Even better when it's kind of a trade you forgot about. It's kind of like you wash your jeans, pull them out of the washing machine, you find a 20 in your pocket. That's always a nice little fun thing. These puts were kind of like that. But it's also emblematic, Matt, of where we are in vol right now, where even crappy garbage penny puts that I bought 8 months ago are now paying off at near $1, sir. So what's catching your eye out there in the vol space and in the market since the last time we chatted, Matt?
Yeah, I mean, you mentioned Trump. I thought he would win, and so I went with the people saying that the market would sell off huge, and I woke up the next morning and the market was flat. I kept hitting reset. Is my internet not working? The market was unched, and I was like, oh, I thought I just made a bundle, and alas, Did nothing.
Trump teases you. Merciless teaser that he is.
Yeah. Yeah, it's an interesting market. I think what's going on out there, I mean, the biggest thing that people want to know is A, why is this market going up, and B, why is the vol so low? And I think they have a lot to do with each other in kind of a vicious circle. I mean, there are a lot of passive investors out there, a lot of CTAs that are controlling just a boatload of money. And when you get in these positions where vol starts to fall, then all their algos say buy stocks, just like the ORATS signals are very bullish right now. Our volatility is falling, that's bullish. We look at three things usually. Contango, the relationship between the short months to the back months, is you want the front months to be below the back months. And that's in a good place and going in the right direction. So that's what we look at. And then that's what a lot of people look at. The only kind of different thing that we've found in our indicators is this forward volatility relationship. And basically what that looks at is two calculations of forward vol. One is what a time spread would price out the volatility, and the other is just the mathematical calculation of volatility from the difference of two volatilities out in the future. And that is very stable. When that gets unstable, then we see that's an indicator as well. So these are all positive right now. So this leads me to the other theory that I have and have read about from people that I follow that I like is, a lot of assets with passive investors and a lot of assets with computer-driven funds and CTAs and such. When the volatility is falling, then they're buying stock. And then when stock is bought, then the volatility falls more and they buy more. So I think that's what's going on in the market right now. And then also, there's some short covering as well. I think the market's very overvalued, but again, I watch my short-term signals. So I have these way out of the money puts and put calendars out of the money that I have on for the eventuality that, if this market goes, it's going to go quick and you're not going to have time to get in. So I think what you want to do is you want to have flat deltas, and which I get from short put spreads because vol's still going down. Those short put spreads are paying for the way out of the money puts. I mean, you bought those way out of the money puts in VIX. So obviously, this is a different thing. I'm looking for the market. If the market does go down, it's going to go very fast, I think, because everyone's going to be running for the exit at the same time. These computer-driven funds are going to be selling all at the same time, and that's why you get these sell-offs that are so brutal. So I think that's the state of the market that I see, Mark. Just so much money's around, passive funds are, and the market I think is kind of holding up the economy, and so I think what's going to happen is, the market goes down, and eventually it's going to take the economy with it. But that's just a bright of light from some bright lights from New Hampshire, Mark.
Yeah, you started off with nice for all the bulls saying your models are bullish, and then the storm clouds rolled in. You started playing the Andrew card of spooking everybody out there. But I get you. I get what you're putting down out there. You mentioned some of your garbage trades. I was joking about my crappy garbage VIX puts, but you got any little garbage VIX trades lurking out there right now that are maybe looking good for you right now, or maybe you're keeping an eye on?
Actually, I'm not as fond of those. I think I know this is crazy, but I think we're in a situation where, if it's going to go down quickly, but the VIX just, people are expecting, there are some people that are expecting it. I think they're going to keep a lid. It's not going to happen like 2018 or like we saw in 2020 when the VIX just went to the moon. I think there's, too many people that are, controlling, that have positions on like mine where they're going to be covering basically. I have the small VIX calls, of course, because I think those are just like your small VIX puts. They pay off more than people think, and So, but unfortunately, I think that that even though the market's going to go down relatively quickly, I don't know if fall is going to follow. So, I know that sounds kind of counterintuitive, but there's been worse counterintuition in the market than that. But that's how I'm feeling about that, Mark.
Given what we've seen over the past couple of years, I could totally buy that. I could totally see an aggressive sell-off, and VIX kind of, we get to 16, maybe a 17. That's kind of about it. We hang out there.
Yeah.
S&P's off 1.5%, 2% a day. VIX just barely budging. I could certainly see a scenario like that. We have seen that a few times over the course of just the last few years. And again, past is prologue, and we've seen a lot of crazy things just in the recent past out there, listeners. So, yeah, it doesn't mean that if we do get the sell-off, we're selling off today, and VIX is doing nothing, right? VIX is going down again, listeners. So we have actually seen over the last week or two, VIX actually moving in lockstep a lot more with S&P, which is what happens. You start getting into these kind of weird ranges. S&P, let's say extremely top-heavy, and VIX looking a little low. Those two can tend to move in lockstep a little bit more, which is always intriguing. Speaking of intriguing, listeners, let's get to all the things that intrigued us in the world of options since our last show. It is time to get the buzz.
Busy financial advisors and asset managers don't have time to follow the latest developments from the world of options. So we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz, the portion of the show where we break down all of the intriguing stories that caught our eye since our last episode. There has been one story that has kind of dominated this segment, again, ever since the pandemic. The pandemic reshaped this show in so many ways, including this segment, because the tsunami of options volume that followed really took a lot of people by surprise. No one really expected the stay-at-home, and the only sport, the only activity you could really do was trade, driving up volume across the board, and yet that's where we've been for pretty much the last couple of years. Even now, the last year and change, that people have gone back to the office, gone back to their actual day jobs, still seeing the flow remain. Now, Matt, I remember you and I talked towards the end of May, and you were saying your volume signals over there at ORATS were telling you that May was going to be a little bit of a down month. Now, there were some drivers, of course, going on in May. Remember, our record month for all time was March, 1.1 billion contracts. And that was, of course, driven by the bank contagion fears that really drove a lot of volume that month. So we do tend to need a catalyst, something to drive us to those lofty record heights. It seemed like maybe the debt ceiling debate could be the thing. Matt was leaning on a little bit of the downside of volume. Was he right? Let's find out, listeners, because we have the numbers in our hot little hands from our friends over there at the Options Clearing Corp for the month of May. And it turns out May actually fairly robust. Not quite a record, but the third busiest month in the history of the business. So nothing to sneeze at. Total volume for the month of May, listeners, 949.1 million contracts, up 9.5% compared to May of 2022. And of course, May of 2022, we all know that was a record year as well. So that May, nothing to sneeze at, and blowing that away by nearly 10%. Again, the third busiest month in the history of options, so going all the way back to the primordial ooze days of 1973, listeners, the third busiest month. So again, nothing to sneeze at, within spitting distance of 1 billion contracts. That is serious paper, listeners. ADV, 44.5 million contracts. So again, the business averaging 44.5 million contracts a day, day in, day out. That's a lot of paper. That's up 6.6% compared to a year ago as well. So again, all other things being equal, if we just maintain this pace throughout the rest of the year, then we're going to be beating last year's already record level, north of 10 billion contracts, by nearly 7%. So looks pretty robust. A couple of other highlights that came through that were notable. Index options, again, for a lot of the pandemic era, a lot of the action was in the single names. Index is kind of the laggard out there. We're starting to see that change around. I think you can intuit why that is. 0 day, really a thing. It wasn't really a thing this time a year ago, so that's driving a lot of this action. Index options volume up 32.5% year over year. We had a great chat with the Flowmaster on our Option Block show a few weeks ago. Someone asked specifically how much of a part these 0 day contracts are playing in this overall volume explosion that's going on. We did a deep dive into that, so check that out if you're intrigued over there at the Option Block going back a couple of weeks. Intriguing stuff, but spoiler alert, it's a fair amount. You're talking close to 1 million contracts a day going up in the SPX that are exclusively in this 0-day phenomenon, if not more. So they're starting to account for more and more and more of the paper out there going forward. So, Matt, a long way around to saying, we were expecting maybe May to be a little bit lighter. I kind of was wondering if the debt ceiling debacle, that was going to be enough to drive us over the hump. And it wasn't quite that, but it was still a surprisingly robust month. I know you were starting to fade May towards the end of the month. Were you surprised at how robust it turned out to be, sir?
Yeah, I cheated. I was looking at the SPY volume, and the SPY volume was down quite a bit.
Cheating will never prosper you, sir. There you go. That's your lesson for you kids out there.
Well, I think the zero DTEs and the SPX are just carrying this whole market, and SPY, it was kind of bumping around, and the market kind of bumped around. It's a good trader's market, I guess, but yeah, I was surprised, and a lot of it's that zero DTE is just buoying the market. The effects of the zero DTE is just going through all markets and all types of statistics and everything, and it just it's throwing me off, throwing the market off, and throwing off these statistics. I mean, that's amazing that we got almost 1 billion contracts, and it was kind of a meh month. Not much happened. So zero DTE, Mark.
Yeah, that's the place to be right now. Just looking at the number breakdown by category, listeners. 487 million equity options, so that's single names versus 455 million a year ago. ETF options, 376 million. That's another area that was kind of a laggard during much of the pandemic, looking a lot more robust now, 345 million a year ago. Index options, 80 million versus 60 million a year ago. So again, huge jump there. The only real dark spot, which has kind of been another persistent factor, are the futures, which, again, if you know much about OCC, the only real futures they clear are VIX futures. So VIX futures, 4.5 million this May versus 5.2 million a year ago. So still looking a little bit dark there. I think they were all hoping over there in SIBO land that the return of the inverse vol products would drive a lot of that paper again. And so far that has not materialized, but I guess we shall wait and see for all that fun. But no more waiting and seeing, listeners, to talk about some earnings vol, because it is time for the earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the earnings volatility report.
All right, listeners, a big part of what goes on there, cycle after cycle, season after season, big driver of volatility across the broad market as well as in single names is, of course, earnings. What the heck are these firms up to? What are they projecting? What is their guidance for the future? A lot of those drivers get baked into everything else we're talking about here on the show, so it only seemed natural, it only seemed sensible to break them out in its own segment. We also, because we like you, break it out in full detail, a lot more detail over there at theoptionsinsider.com. Click on the Options News and Articles tab to go down a deep dive of all the earnings volatility data you can shake a stick at and then some. And, of course, intriguing stuff to be found there. And, Mr. Matt, if I didn't know better, sir, I'd say you were gaming the system this cycle, because our long-term average, since we've been running these numbers, which goes back to well before the pandemic at this point, the long-term average is 96%. So remember, listeners, 100% would be if every straddle, every single name performed exactly as much as their straddle was pricing in, then that would be 100%. 96% would be a little bit light, a little bit lower than that. And this season, Mr. Matt, after bouncing around wildly, getting up to 150+% at one point, has come back down and settled out at exactly 96%, sir. So at exactly our long-term average. What do you say about that, Matt? Are you gaming the system, sir?
Didn't cheat on this one, Mark, but yeah, it is interesting. I mean, and 96 has been pretty good, given what's been going on in the market. And, the five stocks, the big five are really carrying the whole market is what I'm seeing. And so we're seeing some volatility in a lot of the other ones, but, it sure seems like the earnings volatility is higher than the market volatility. So, because, a lot of times what you'd see in this type of a market where the vol is going down is you'd see something in the 80s. But we're seeing, we saw right on the average. So, I think this is a canary. I think we're going to see some extra vol coming up, especially during the July earnings. That, people seem to be, in summer mode. And then, I could remember many, I've been in the markets for so long, I could remember many July earnings months that were just crazy. So I think we're going to get a pretty big one coming up. I think we'll eclipse the 100. So you're making money owning straddles in this next earnings move, Mark.
Yeah, it seemed like for a while there in the early days of the pandemic especially, it seemed like no one cared about earnings vol anymore, right? Earnings were just going to die. We were getting seasons in, the 70s, low 80s%. Vol was just anemic. And slowly but surely we've managed to claw our way back. Obviously not going to budge the needle this cycle because we came in exactly in line, but still 96%, as you mentioned, Matt, definitely respectable. Go back a couple of years, listeners. Listen to what we were talking about for earnings vol a few years ago. It was in the low 80s, if not below. So this is definitely respectable. Getting back to a level where, as Matt says, earnings vol matters. Earnings vol is real again. So intriguing stuff. We're kind of in the tail end of the season now. The dregs are starting to come through. But don't worry, we'll reload the gun. July, a whole new season will be upon us, and we'll have all the data for you, courtesy of our friends over there. Or that's because we like you folks. Available over there. TheOptionsInsider.com is the place to go. But you've been waiting for it. Mr. Matt's been waiting for it. Now it's time for us to go into a little bit of our old mid-year office hours palooza. You folks are always kind enough to send in a bunch of questions. We like to try to clear out the mailbag at least a few times a year. Time to do that now. It's time to put out our shingle for our office hours extended edition.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, let's do it. Let's see how many of you folks we could squeeze in the time we have remaining. Remember, if you want to get at us, join your fellow listeners. No shortage of ways to do it. Questions@theoptionsinsider.com is kind of the catch-all for the full network. If you have a specific show you want it to go to, in this case, the advisor's option, just put in the subject somewhere, question for the advisor's option. We'll make sure it's routed to the appropriate show. A lot of you like to get at us on social media. @options is the place to go for those as well. Of course, if you're one of our pro members listening live, you always get bumped to the top of the list. If you're in the live chat, you have a live question there as well. Let's see what we've got in store for us this week, Mr. Matt. Let's first go. I like this handle. This is just a fun handle. He should get bumped to the top of the list just because he has a fun handle. This is Analysis Paralysis. All right, Analysis Paralysis says, well, it looks like he's doing some analysis too, so he's living up to his title. He says, overall volatility in SPY is currently quite low. Yes, you are correct. We were just crunching the numbers last week, and we were hanging out in SPY and SPX at anywhere between the first and the second percentile for the year. So, yes, a fairly anemic. Of course, you don't even need to do that analysis. Just look at VIX. It's a good backdoor way into seeing that vol not exactly booming right now. He goes on to write, is now the time to start looking at purchasing portfolio protection for my larger clients? I was looking at puts in the 2 to 3 month time frame at approximately 2 to 5% out of the money. Are there any other variables I should be aware of when planning these trades? All right, Mr. Matt, I have some thoughts, but I know you're pretty eager to get at our listeners. So let's start there. What do you have to say for the creatively named Analysis Paralysis? Should he be looking at puts in the 2 to 5%, or 2 to 3 month, 2 to 5% out of the money frame in SPY right now, sir?
Yeah, those aren't my favorite. I mean, if you backtest those are quite expensive. Now, what I like to do is I like to go much farther and much more out of the money. And what tends to happen is that I've said numerous times here, that it doesn't need to go there, but just the fact that it's going towards that and vol's going up, those really pay off, and they don't decay very much. So, I think it's, and of course it depends on the clients and their expectations, because, you want to, if the client's expecting these to be in the money on a sell-off, you might need to do something. But I'm just talking about, for me, what I do to protect my portfolio is to have these out of the monies. And even those, what I'm doing now is I'm actually selling a shorter term out of the monies. So it's more of a put calendar. And that limits the risk as well. And I'm doing that until I see something in the market that puts a chink in the armor, because it's still in an uptrend. I think we're going to see I think it looks bullish still, and I'd like to see more signs before I get aggressive. And I would consider what analysis paralysis is suggesting as a fairly aggressive hedge. So expensive. And doesn't backtest well, so I'd be careful on that. As far as 2 to 3 month time frame, 2 to 5% of the money is going to be. I think we backtest that at something like -4% a year, and that's a pretty big drag, especially where interest rates are now. Mark,
do you ever find yourself suffering from analysis paralysis, Mr. Matt?
I think that's been the story of my life, Mark.
You got to change your handle on Twitter. I'm sure it's taken. Maybe you can negotiate with Mr. Analysis Paralysis here for a cool handle. But yeah, you're right. You make an interesting point. It may sound counterintuitive to some of our listeners to say, well, vol is low. How can these puts be expensive? But they are still fairly juicy. In fact, we also crunched the numbers on, we weren't looking at quite 2%, a little bit farther out of them. I think more between the 5 to 10% out of the money range, which usually is where you're looking at SKEW. Remember, you're looking at SKEW when you're measuring SKEW, usually at the 25 delta put range. And looking at those numbers, crunching them back, we are still looking, even though vol itself is at somewhere in the 1 to 2 percentile right now for the year, SKEW is at about almost the 30th percentile, about 27th percentile right now. So still low, but it's not in the bottom percentile right now in SPY or SPX the way you might think it is. So just bear that in mind. There still is some juice to be found in some of these 25 delta put range. And as Matt alluded to, it's still not super cheap. It's cheaper than it was. And again, for this trade to pay off, you really do need what Matt was talking about earlier, this market kind of falling out of bed. You need to have that happen pretty quickly. There's no room if you're buying these puts, even at this lower vol level. There's no room if you're buying these puts to kind of dilly-dally and hang out and have these days where the market is either roaring up or kind of gently drifting up, or even just kind of hanging out sideways, because those puts are going to lose juice every day. So you need to be fairly certain that this thing's fallen out of bed in the lifespan of those puts. Otherwise, what Matt is alluding to, these types of trades that allow you to have some table stakes while you're waiting for that big moment, those are probably a better way to go. But I just mentioned SKEW, Matt. That kind of leads nicely into our next question here from Peter. Peter Attack. I don't know who you attacking, Peter. Hopefully you're not attacking us. We like all of our listeners out there. But Peter Attack wants to know, how do you traditionally compare SKEW across products? Well, I kind of just said one standard way, Mr. Peter Attack, which is, of course, looking at the 25 delta put, looking at the 25 delta call, and then comparing and contrasting. I like the way, I've said it before many times, and I'm sure Matt has his own metrics as well. One of the ways we use here on the network, and I do wish they would start applying it to other products, and I have chatted with Nick about this, and they are starting to finally apply this to products beyond the futures options. But one of my favorite things is the quick SKEW, because it shows you exactly where the puts were last week, where they are now, how much they've moved and evolved, and the calls as well. They show you the 25 delta put, the 25 delta call, how much those wings have evolved over time. So it gives you a nice moving number on both sides and a nice little graph. Because if you're talking SKEW, that's one of my problems I have with something like the SIBO SKEW index. It's just one number. They throw out, okay, it's at 155. If you're the average trader out there, what does that mean to you? Does that mean the puts are bid? Does that mean the calls are cheap? Is it somewhere in between? You don't know. You have to do a lot of digging. not a lot of utility in those one number SKEW measures. So I find things that measure the SKEW wings independently, the call wing and the put wing, 'cause at the end of the day, they are very separate beasts. If you want to see how these things do whip around across asset classes, Peter Attack, I encourage you, maybe you're doing so already, check out our This Week in Futures options program. We really go deep into SKEW on that show using that quick SKEW methodology. And you could see just going from, let's say, the metals to the equities, to the ags, to energy, to rates, going across complexes on everything that trades at CME, for example, to crypto. You see how much the SKEW evolves from asset to asset and product to product. So everyone listening to this show, you're probably used to the traditional investment SKEW. The puts are bid, the calls are offered. It's kind of just a question of degree. Not the most exciting of things, but you get out in some other products and things start moving. Calls all of a sudden, oh my God, people are actually buying calls. They're bid over the puts. Happens all the time in the metals, for example. So intriguing stuff, and that's one way I like to look at it, is using that kind of quick SKEW methodology to come up with a nice holistic approach. But Mr. Matt, what are your thoughts out there for Peter Attack? He wants to know, how do you traditionally compare SKEW across products, sir?
Yeah, you bring up some great points. I mean, the first thing is you start with delta. If you don't use delta and you're using some type of percent or even standard deviation, you're missing a lot. And, a lot of people use 25 delta. Of course, you're going to hear from me that we like the way that we do it. The problem with the 25 delta is, think about the look of a SKEW. And if you go on ORATS.com and you look at dashboard.orats.com, you look at our option chain, we show the graph of each month. And, sometimes it's a smile like in crypto, but other times it's a smirk, and other times it's pretty straight up and down. So what you miss with the 25-25, that is a 25 delta put and a 25 delta call, is you miss the first thing you need to do is take the smile out. So once you take the smile out, then you have a flat line. And that flat line is your slope line. So we take the slope of that line. And so what we think we have with what we call derivative and slope is we have a very accurate measure using delta and using, a lot of options, taking the tangent and figuring out the smile, that we have a very accurate, what we call a slope. And that slope we graph, all the way back to 2007 in SPY. And right now it's pretty low. It has come up in the last few days, but it got really low. And just the point before, I mean, that is a good time to buy some puts, actually. When the SKEW is low, what that means is the puts are low. So that when we talk in SKEW, we're talking mostly puts over calls, because everyone's thinking about puts when they're talking about SKEW. At least my clients are. So yeah, and our percentile is in the 40s, so pretty close to what you said. But it is low right now, and so what I would encourage people to do, if they're really going to dive deep on SKEW, is consider the derivative. Most people don't, and so you're right, Mark, as you mentioned. Does that mean the calls are high? Does that mean the puts are high? Well, the first thing to do is to take out that smile. Second thing to do is get that tangent. That gives you the slope. The smile is the derivative in ORATS parlance. And then you look at the implied volatility, and we do that for the short term and for the infinite. And that's how we kind of get a parameterized full volatility surface. Now, obviously, we're going to be missing some wings and all that. But the first thing to do that, before you even think about the wings, is to get the slope, get the derivative out of there, and take a look and start your thesis there. And I think those are the steps that you need to take, Mark.
Somehow I had a feeling you were going to take issue with traditional 25 delta calling, but I knew you were going to have your own custom way of doing it. But intriguing, you mentioned that. You also mentioned crypto. I know a lot of our crypto analytics people we talk to, they because there's a problem with liquidity out there. It's hard to just find enough measurable data on the 25 delta strike, that you have to take more of a range. They do the 20 to 30 delta. So there are, as you mentioned, a variety of ways to analyze SKEW across products. So there you go. Who was it? Attack Peter. There are a couple of them. There's the standardized way, kind of 25 delta put, 25 delta call, equates to the 50 delta risk reversal. Of course, if you want some alternative ways to do it. check out what Matt and his team have cooking over there at ORATS, ORATS.com, or just check them out on Twitter. Good follow over there as well at Option Rats, all one word. As we keep on going, we got some funky handles today. Meetaw? I'm going to assume that is Meetaw. Meetaw wants to know, where do you find the sweet spot for the stock substitution strategy? For example, I'm thinking of unloading some of my clients' positions in high flyers like Meta and NVIDIA. Well, yeah, those have looked pretty good over the last few months. So congrats to you, Mita, and to your clients for holding on to those. He goes on to write, what is your preferred structure in names like these versus traditional indexes like the Qs? Intriguing. Before you answer, Mr. Matt, let me give some results, because we actually asked a question to our audience recently that was right along these lines. It was during our Vol View show last week. We asked our audience, are you taking advantage of this lower VIX and modest call skew to trade some stock substitution in SPX or SPY? And the audience came in pretty firmly in the yes column, 60% for yes, 40% for no. I thought it actually would be a little high. It actually was trending higher for a while. Towards the end of the poll, seems like some of the negative Nancys came in and drove it back down. But still ending up 60% yes. So our audience definitely intrigued by stock substitution right here as well. So, Mr. Matt, are you a fan of stock substitution in high flyers like Meta and NVIDIA? And also, if you're going to set it up, do you do it the same or differently than you would in an index like the Qs? Mita wants to know, sir.
Well, let me just tackle this from a different way. I agree. Like these stocks that have just driven, I think the 480 other stocks are flat on the year, and so this is just driving the Qs, and so you'd want to have some way to play. If you want to be long the rest of the Qs, you got to take these the small ones out. And how do you do that? You could do it risk reversals, or you could do. But I'm not that risk averse. So I'm risk averse. So I do something like put spread call spreads to get short in Meta and NVIDIA and get long in Qs and go against each other that way. So you isolate the deltas. And you're flat. You could probably get pretty flat volatility because the top five represent 57% of the Q. So that's how I think about it. But I don't do a lot of this of that type of stuff. So I'm not the person to ask so much. But that's where I'd start to lean that way, Mark.
Intriguing. Yeah, I can't disagree with Matt. I don't think taking some of if your clients are sitting on some gains here and you're worried, maybe think they're a little top heavy, at least in your outlook, doesn't hurt to take some of that off the table. Of course, there's tax implications for that. You're an advisor, so I'm assuming you're aware of that. But if your clients are okay with taking a little bit of a tax hit, and at the end of the day, are you really mad paying taxes if you're making money? Probably not. But that said, as long as they're okay with that, then there are worse times to do stock substitution. Of course, listeners, if you're not familiar, go back into our archives to check out. We've talked about stock substitution on this show many times. We've also done it on the Options Bootcamp program. So 2 places we can do a deep dive into stock substitution if you're unfamiliar with the term. But traditionally, it involves dumping out your underlying position. So in this case, maybe selling your shares in Meta or NVIDIA. It doesn't have to be all of them. Could be a ratio. Could do some of it as well. Just take a portion off the table. So now you've taken your gains, taken that risk off the table, but you still want to have some skin in the game. So a lot of different ways you can go about it. Matt just broke down one. The traditional stock substitution is going to go out. You want to go out a little bit farther with these, usually at least 3, probably 6 months. And you probably want, if not longer. And then also you want to get a little bit more meat on the bone. So you want to go maybe a little bit more in the money with some of the options you're going to buy in this case, and in the money call. 70 plus delta maybe might be a good starting point. Higher if you want a little bit more bang for your buck. A little bit lower around that range if you want to keep your outlay low. Kind of depends on the person in the trade and the setup. But again, you're buying options right now, so lower vol is going to benefit you there. And then you have some skin in the game to the upside if the stock continues to run. If it drops to the downside, you've taken your underlying off the table, or at least a good portion of it, and all you really have left at risk is just whatever you paid for those calls. So it's an intriguing trade, especially right now. If vol is high, I wouldn't be as enthused about it, but because it's going to cost you a lot more to do the option leg. But right now, vol is fairly low. We just talked about it. And you can maybe argue some of these stocks are a little bit top-heavy. So a good setup potentially for stock substitution. Again, if you want deeper dives into how we set those up, how we do them, what they are, check out the archives of this show or check out Options Boot Camp. Let's keep going. Oh, Matt, we were just talking about this earlier. You've become known as the garbage man. I'll change your nickname to Matt the Garbage Man from ORATS because you like your garbage trades. In particular, a money pit with a dollar sign. So he's very, very clever and trendy here. Money pit with a dollar sign wants to know, can the garbage call and put concept be applied to just about any equity? Or are they only useful in broad indexes like the S&P 500 and volatility indexes like VIX? Thank you for your time. No, thank you, Money Pit, for taking the time to write into us. Mr. Matt, I was joking at the top of the show. You've always got some garbage on in SPX or VIX, but Money Pit wants to know, can you do this outside of those two products? And have you had any success doing so?
Yeah, it gets real expensive. Back when I used to back traders, we used to try to get, free calls on, through way out of the money time spreads and even verticals for very low prices. I always love to have those on, but it's very difficult, especially with all the computerization picking off all the good trades. But, if you have some type of a good technology and you could get some small calls and small puts, those are money to have. You come in and the market's way up or way down, you're happy. So just like you, Mark, you come in, all of a sudden you see green in one of your accounts and you're like, what's going on? We always love that. So, as a small trading firm that I ran and backed, we'd always like to have those bullets, we call them, just having way out of the money calls, way out of the money puts for cheap. Sometimes you'd have to get them in creative means, like I talked about, like put on a butterfly and then the whole thing goes down and then you buy in the middle and then you have two calls. So things like that. I love to have those, but it's really difficult because you end up paying a lot unless you get creative, like I said, and you have some good scanners. I mean, ORATS has scanners and we look for these way out of the money call spreads, calendars and such. Sometimes you could put those on for pretty cheap, and those are always good to have. So you're not going to probably get the individual legs, but you may be able to get some calendars or some verticals out of the money for cheap. And again, we have the whole volatility surface forecasted, so we could see what we think they're worth. So it's difficult to do all that, and then plus we have that summarization, we call it the smooth market values, SMV, and we have a theoretical value for every option. So some of these wide names, you can get a theoretical good call or put, but you really have to watch it and use those theoretical values in order to not overpay for those, Mark.
Yeah, good luck getting these off in any of the names you want to trade them in, right? Like, try to find these garbage calls in NVIDIA right now, right? Good luck. Sometimes, they are, often I should say, they are, as Matt alluded to, a little bit juicy. That's why in some of the indexes, they can be a little bit more attractive, a little bit easier to put on. But, not impossible, just you have to do some digging, like maybe use some of Matt's scanners over there to find them. You want to find them before the horse has left the barn, right? Before the NVIDIA has had its big pop. If you can put them on before then, obviously you're looking pretty good, but that is the challenge. There's the rub out there. Speaking of Matt's scanners, we're kind of already coming up against it. Man, time flies when you're answering questions here. So I want to make sure we get this one in, Matt, from Meats, because it's specifically for you. Let's go to this one. We were talking about scanners. We have a couple here that I want to get to. Let's go to Safudi first. Safudi, this one has specifically for you, Matt. He says, this question is for Matt from ORATS. So you sent it into the right show, Safudi. You passed the first test. He says, I've been drawn to your website a few times now. I manage a variety of large clients as well as a number of smaller SMAs. I mostly construct overlays and products ranging from SPY to Tesla. Are there tools in the ORATS library that will benefit someone in my position? All right, Mr. Matt, it sounds like he's been lured to the dark side a few times. He's visited ORATS.com, hasn't quite pulled the trigger, still has some questions. Get him over the hump. What's going to lure him to the dark side of auto, sir?
Yeah, clearly, we say yes. We have a bunch of tools. Our philosophy is to run the gamut. So we do research, starting with back testing and having great data, as we talked about throughout this. And then once you do the back testing, we have paper trading. So you could paper trade some of these strategies that you're thinking about. So you could, show a client a back test, and you could show a client that you're paper trading it. We have now alerts. So if you wanted to put on a position and you wanted to get out with 50% profit or 50% or 75% loss, stop loss or whatever, you could get alerted that those losses have come up. And so you can paper trade and manage these types of strategies that you've already back tested. And then we have these scanners, both stock scanners and option scanners. So, if you have, 30 or so stocks and ETFs and indexes that you're watching, and you want to see if the, ratio of the IV10 over the IV30 could do, an unlimited amount of ratios. And we have about 1,000 indicators that you could use, from SKEW to volatility to constant maturity with delta. So there's a lot of things that you could use to rank your stocks in your list, and then you could then do the appropriate overlays. Like, for example, the question earlier about NVIDIA and Meta, you might want to do a collar right now because or something to protect those gains, right? Because the puts, you can buy the puts, they're somewhat cheap compared to the calls, and you could sell the calls. So this would be a good time for a collar in those individual names, most likely. So those are the types of things and types of tools from scanners. And then the option scanners, we back test and then we put it into an option scanner. You can construct an option scanner to show you, what are the best options, either from our forecast, from a distribution that we've done historically, or from our smoothing. Where is the edge lie? So there's a ton of tools that you could use in ORATS. We've got more videos explaining a lot of the tools that we have. So yeah, definitely we have the tools, the data, and the instruction in order to get most people going on whatever strategy they're looking at, Mark.
I want to squeeze one more in here. In the time we have remaining, this comes from Meats, also for you, Mr. Matt. He says, does Matt feel that butterflies, either regular or skip strike, are not worth doing when VIX is in the low teens? And what is his preferred volatility level to trade butterflies? Obviously, flies pretty popular, all different varieties, regular, symmetrical, skip strike, all that fun. Meats wants to know, Matt, do you feel that they are not worth doing with VIX at these levels?
So it depends what type of a butterfly. I've actually traded more butterflies recently than I ever have, and that's because I'm in the zero DTE space. And I like to do it near about an hour before the close, and then what you do is you look at where a lot of the volume is, where a lot of the open interest is in the zero DTEs, and the market sometimes tends to go towards those strikes. And so those are the the VIX doesn't really matter that much in that case. So those are butterflies that I like to do in this environment. A butterfly, and some people use a butterfly as a way to sell vol. Is VIX is too low. We've mentioned this on the show a number of times. What I've learned from millions of back tests is the market never gets the vol low enough and never gets it high enough when it's high. So what that means is even in low vol environments, the implied volatility, and I'm talking historical vol versus implied, the implied never gets low enough. So actually that's probably a better time is when it's low. So I think the butterfly to either sell vol or less risky way to sell vol is decent still, and as a way to find some strategy in zero DTE that might pay off with the volume and the open interest. I think the butterfly is a good way to play that as well, Mark.
Well, since you hit on zero DTE, I lied. We're going to squeeze in one more because it segues nicely. Let's go to Wolfpack. Wolfpack wants to know, is there a particular strategy your guest feels is most effective in short duration contracts like 0-day SPX? I'll go out on a limb and say you think butterflies, Matt.
Well, I trade different strategies at different times of the day. I know that sounds kind of funny, but as it gets closer to the close, I do the butterflies. And during the day, I'm looking at our 1 minute volatilities. I look at the 10-day implied and the 30-day implied and where they are versus like a moving average, like a 20-minute moving average. And what you can do is you could get a feel for where the market's going, bullish or bearish, and do some verticals around that. And early in the day, you could usually get a pretty good vertical way out of the money. If the market hasn't gapped, those have been probably the most profitable. So, if volatility is decent and you could sell an out of the money vertical, either call spreads or put spreads, in the morning, you could usually collect by later in the day. You don't set them too wide, and you have a stop loss on them, and those for the most part are paying off. So those are strategies for different parts of the day. Call verticals, and then verticals to get long or short, and then the butterflies as you get closer to the end of the day. Mark.
All right, there you go. Who was that? Wolfpack. Look, you got multiple answers for different parts of the day. Bet you didn't think that. Throw it in there, Mr. Wolfpack. Great questions, everybody. That music means we've come to the end of another fun episode of the Advisor's Option. Man, time flies. We're chatting about all things advisors and options, and in this case, answering a few of your questions as well. Mr. Matt, we kind of just chatted about what you guys have cooking over there at ORATS that may intrigue our listeners. But before we go, if anything else you want to mention there, any other tools or nuggets or things you guys have up your sleeve that's going to be coming down the pike soon that may intrigue the audience, now is the time, sir. The floor is yours.
Yeah, we've been blowing away our users, actually. So we connected to Thinkorswim, TD Ameritrade / Schwab. So you could trade directly into your Schwab account. So that's been really great. I have one of those. And then Tradier as well. You could trade right in. We're working on TradeStation and Interactive Brokers as well. So it's really convenient using our scanners to find the trades, click them through, get alerts when you get out. It's really it's really fun to trade. I know it's weird to say, but that's really cool. And then we've made our backtester a lot easier. We've run, I think, 100 million backtests and put them up in a table so you could sort through them. And, in case you're thinking you might overfit, you could then run various backtests that are slightly different to see, if it still holds up. You could trade it in paper trading to see if it still holds up, and then trade it small, and then and get into it. So it's really cool, Mark. I can't wait to show it to you. It's a bunch of backtests. And we also are able to identify the current environment. So, right now the market's above the 50-day. It's in an overbought RSI. The VIX is kind of moderate, actually, if you can believe that. And the slope is low. So you could search for backtests that only trade in two or one or none of those environments and see what works the best in today's environment. So that's really cool. So that's been our focus, and that's our newest product, Mark.
There you go. Check it all out over there. ORATS.com, ORATS.com, the place to go to kick the tires and light the fires. And while you're online searching for some options information, don't forget our friends over there at the Options Industry Council, optionseducation.org, the place to go to kick the tires and light the fires over there. That's going to do it for us on the network today. If you're listening live, we'll be back again tomorrow. Got a multifaceted offering for you folks out there tomorrow. Going to come in early with a little bit of an early live segment for TWIFO, talking to our friends over there at the Russell 2000, FTSE Russell, talking about Russell Recon. It's that time of year. There's always some interesting data, some interesting nuggets that come out of the market from the Russell Recon process. So we're going to break that down with those folks a little bit before our usual time. That'll be at 11 a.m. Of course, noon with the old OB. Will be joined by the Flow Master and everybody else on that show. Should be a fun time. Then Twifo at his usual time of 1:30. And then after that, because we love you pro folks, coming in hot and heavy with Mr. Overby, the options guy himself, taking on all your questions in a great pro Q&A session tomorrow, 3 p.m. Central. Friday, of course, our usual offerings, noon Central for ball views, back again, 2 p.m. Central for options oddities, exclusively for all you pro cats and kittens out there in the old secret club. And then back again next week, and indeed next month, another episode of The Advisor's Option. Stay safe out there.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.